Okay, back for round two with something quite different. Going to be far more visual. I reached out to some of you and asked you, what kind of stuff would you like to see? What are you interested in? I got some feedback, and I've decided to ignore all of you. Haha. I'm just kidding. Um, but this is different from the feedback I received, but I think is extremely constructive and feeds into the bigger picture. So I'd like to tackle it, and we'll kind of go from there. Basically, what I want to look at today is the fractal nature of markets and why price structure matters, and why it's the only thing that matters. So, let's jump in. I've actually created a slide deck today, and then we'll actually get into the application later on and look at some things hands-on. So, what are fractals? What is a fractal? Well, fractal geometry is a method of geometry. It's a tool. So most of you are probably familiar with Euclidean geometry, plane geometry, plane with an E. So, drawing lines in a 2D space or even 3D space. Fractal geometry is something slightly different. Easiest way to understand fractals is to classify them as infinitely recurring patterns. So, a picture's worth 1,000 words, so let's look at some. This is probably one of the more famous fractals, known as the Sierpinski triangle. So, what do we have here? It should be pretty easy to see what's going on. So you start at the outermost shell, you have a large triangle. Hopefully everybody can see that. And within that triangle, we have smaller triangles. And within each of those, we have the same pattern repeating and repeating and repeating and repeating. Should be pretty easy. So this is an example of a fractal constructed around Euclidean geometric objects, such as a triangle. Okay, pretty simple. Let's look at something a little different. A tree. Yes, that is the technical name of this particular fractal. I'm just kidding. This just looks like a tree. So we see the exact same structure starting at the trunk of the tree, branches out into a Y, and we see that each subsequent branch of the tree is the same pattern repeated. And we could do this infinitely. It looks like this tree has a total of 1, 2, 3, 4 iterations, if I can count properly. Whatever, 4 or 5, whatever the number is. But same exact principle. So now we've seen, fairly basic fractal, one that's a little more complex, non-Euclidean. And now we can look at one of the most famous fractals, named after Mandelbrot himself. It's known as the Mandelbrot set. And this particular visualization is derived from doing some numerical mathematics on the Mandelbrot set. This is an image you may or may not have seen before, and the reason I threw it up here is to show the progression of complexity from simple to more complex, show the power of these things. If you're interested in any of this stuff, I'd highly recommend you Google Mandelbrot. He's unfortunately passed away in the early or mid 2000s, I believe, but he has a huge body of work. Very interesting guy. I highly recommend you look at it. So, okay, those are fractals. What do we know about fractals? How did Mandelbrot come to use them? So, fractals, as many things in mathematics, are present in nature. It's actually very common. One example that I can think of off the top of my head is the shape of coastlines. So if you take a coastline and draw it, with a really fine point pen, you might come to the conclusion that it's pretty random. And the challenge then becomes, well, how do I model that? Is there anything that I can use to create a structure that resembles that of a coastline within, my set of mathematical tools? And the answer is yes. In fact, I can use fractals to model such things. And tons of other very interesting structures and formations. So you might have seen this question coming. What about prices? The answer is also yes. It's a fantastic book. If you're interested in Mandelbrot's work, his story, fractals, fractal geometry, finance, how it applies to finance, I highly recommend you pick this up. This is probably one of the best books I've ever read. And it's been quite a while since I've read it. It's probably due for a reread on my part. But this is completely accessible to anyone. You don't need to understand anything about financial markets, how they operate. It's very non-technical, but extremely powerful. Really cool stuff going on in here. I highly recommend you pick this up. So, similar to the question we posed in regards to, well, okay, how do we model complex structures like a coastline? Seemingly random, unorganized, unpredictable structure. Same might be asked of, okay, well, how do we model price? How can we model price? So the answer that modern finance and university has taught us is, we use a variety of systems, progressively more complex, so we can model price off of the immediately prior price. The base assumption there is common to more complex models, such as Black-Scholes uses non-discrete values of price, assuming that a price at t plus 1 is most closely modeled by its immediately prior value at time t. It's pretty simple. You move into ordinary least squares regression or non-parametric regression. You can use multivariate models where you create various factors or variables that are used as predictors and weighted by a coefficient to model price. You can use stochastic models, other fancy things, as I've called them. Here's a novel idea. What about drawings? Can we model price with a basic set of structures, apply the fractal geometry framework, and draw these structures recursively, repeating upon themselves, and model price that way? What I've drawn here is 4 basic trade patterns used by many professional traders. We can get into these probably in another discussion, another video. But basically have long continuation, which is where price is moving up, pulls back, finds support, and continues in its upward path. You have the opposite of that, which is a short continuation. Price falls, retraces, finds resistance, and continues downward. And then you have the failures of each of these patterns. So you have a long reversal, reversal long, the bottom left-hand corner, which is simply a failure, as you can see, of a short continuation. So price moves down, retraces, finds resistance, resumes its move down, but this time fails to make a lower low, so finds support above the prior support and reverses. And the same for the short reversal. It's just a failure of a long continuation. Price rises, makes a high, pulls back, finds support, comes up, finds resistance below the prior high, and subsequently turns around. So let's see what happens. I'm going to look at a couple of charts. So what is this a chart of? What might this be? Is this chart of Google on a daily period? Is it a chart of crude oil over a week? Is it a made-up series that I typed, that I created? What is this? What about this? Is this the dollar? What's the time frame? What about this one? What stock, commodity, option? What is this? What are we looking at? So now my question for you would be, which of those three is a real chart? And how can you tell? What were the time frames? Take a moment and think about that. And take a guess. Write it down. Or don't. Whatever. I'm going to tell you either way. So let's look. So our first chart was a 5-day chart of crude at a 5-minute frequency. That was the actual price series from the market. The second chart was our fractal price series, created from an amalgamation of using only these 4 price patterns. We're able to create this. Looks, I don't know. Does it seem to capture the nature of price? Well, I'm not saying does it mimic, does it predict the value. I'm saying if you just look at it. Notice that none of these pictures have time or price scale depicted. That's by intention. We are looking to see structurally, is this an effective tool for modeling price? And we'll get into the implications of what that means later. And finally, we have the another crude chart at the very bottom, and that is a 10-year chart on a daily frequency. Alright, so all that's to say is another principle of fractals is, and furthermore the implication here is that markets are fractal. Things that we see happening on the 5-day chart at the 5-minute frequency are mimicked and look identical to, in many cases, things that are happening on a 10-year daily chart. We remove the time axis labels and price, that's almost indiscernible. So keep that in mind. Are you surprised by this? I would be. I was, I know I was the first time I went through this. So, having looked at that, what can we do about modeling price using fractals and price structure? And this is just an excerpt from code that I put together that accomplishes exactly this. In my native trading platform, of all things. We'll dig into that code deeper here. So that's the PowerPoint. Let's go ahead and jump straight into the platform itself. Okay, so we're going to do a couple things here, including examining the underlying code, verifying the notion or theory that markets are fractal, examining what that means, tying that back into our patterns, and then showing how we use that information, how that information might be used. So I have plotted on my chart 10-year daily of crude. It's the same image that we reviewed. I think it's the last chart in the presentation. And we have nothing attached to it. So let's pull up this, our code. Before we set anything, let's dig in really quick. Actually, you know what? I let it know. Let's go ahead and just run it. Okay, great. Get these to be about equal. Okay. So we have our actual price series here, and then we have just a price series generated by the composition of those fractal patterns. There's 4 basic patterns. Alright? So how does the composition of that look like within our code? It's actually pretty simple stuff. So we define the probability of occurrence of each pattern. For purposes of simplicity, the base inputs are set at 25% apiece. We are going to use the average true range as a volatility scaling factor, because we know that you don't see this so much on a daily period, but we'll look at dailies, we'll look at intraday here in a bit too, and we know that during active hours, for example, we get more trading, higher price moves, etc., etc. We need a way to capture that. So we use average true range. It's actually a pretty good proxy. We have a requirement that the probability sum to 1, and a redundancy declaration. We only want to run this per bar. Otherwise, we'll be getting a changing price series on the fractal side every single time there's a trade. And that's just due to the nature of the construct of ThinkScript. So we then define 2 cases. We're going to define the structure case and the pivot case. Each of our patterns has 5 points to formation. I'm just calling them pivots. And then we have a random number generator which is going to be used to assign the particular case, whether that's an upward continuation, downward continuation, a two-step, or two-step down, and then the simulated price. So essentially what we have is 4 case statements. We have the outer case statement, which switches the structure variable, and then we have internal case statements, which change the pivot variable. And so we see that that's repeated for each case here. And all we're doing is emulating those structures that we discussed before. So for example, let me get the PowerPoint. So if I want to compose the long continuation pattern with 5 pivots, I start with, let's get a way to highlight. I'd show my cursor, except for then the video gets messed up. How about circles? Cool. Alright, so pivot 1 would be here. You're going to have, oh, come on. Pivot 2 here. Pivot 3 here. Pivot 4 here. And then pivot 5 up here. Same sort of application for the short. The reason we're using 5, you might say, well, hey, okay, this only has 4 pivots. Yeah, you could view it that way. The reason we're using 5 is that we see very clearly that on these reversals, there are 5 pivots, and structurally within our code, we need to have the same number based on the fact that we're using a case statement. So all we do to resolve that is for the tail leg of the long, we just subdivide that last leg into 2 components. So we know, for example, if we're going to define the move from here to here, let's get rid of this crap, as a length, or a unitless magnitude of 3, then we can just divide it into 2 components of 2 and 1, right? And that way we fit the confines or the constraints of the code structure. So all we're doing is we see actually, what if, here's a novel idea. What if we actually utilized all the screen space, or most of the screen space? Oh, incredible. Okay, so when the pivot number is 1, shit, this sucks. It's going to do this every time. Okay, when the pivot number is 1, we are here, as we discussed before, and we come in and make an assignment to the simulated price variable, and we're just using it as a step up of 1, right, times the volatility proxy. We set the counter to the next counter, and maintain the same price structure. This notation here just means the prior value of the variable. And so when the code iterates and we step to the next bar, we will now be in this case statement, and we can take the appropriate steps, appropriate additions, subtractions, etc. to create this structure here. And we repeat those case statements for the remainder of these. So through the process of that, I create each of those, and then I just simply assign the value of my simulated price to a plot, and then run it. And there we go. And we have the ability to come in and toggle the occurrence of each of these. And just as a rough proxy, once again, we know that markets typically trend more than they reverse. So if we adjust the number of continuations to 30%, upward continuations to 30%, downward continuations to 30%, assuming that they're roughly equal, and then the resulting reversals to 20% apiece, which is sum to 1. See that and apply it, we're going to get a slightly different structure produced by the fractal model. Now this structure looks a little bit better than using 25% weightings for everything. It's pretty interesting. It actually looks pretty darn close. Mimics price pretty well. It's actually pretty cool. So now what I want to do is, we've been plotting this on a 10-year. You say, well, okay, you know, it seems to capture the notion of price. Note that the ending value is inaccurate, right? So we started at the same value, 54 here, 54 here on the left hand side, and the upper series represents what actually happened, and the lower portion just represents a randomly constructed fractal series. And the point here isn't, oh, will this randomly generated series give us, you know, a prediction of the future? It's just a question of, does it look like actual price? And it does pretty well, actually. And we'll discuss the importance of that here in a moment. First one I want to do, though, is talk about, okay, we're on a 10-year. What about if we go to an intraday? So what if we look at 5 days on a 5-minute basis? I'd say it's pretty solid. Shoot, you know, even came within a couple bucks of where the actual price ended. You know, let's try a different instrument. Let's look at, I don't know, let's look at the S&P. Okay. Once again, the upper chart showing actual price activity. Lower chart being the fractal representation. And mind you, excuse me 1 second. Sorry about that. Lost my train of thought. Okay. Well, okay, whatever. You know, and so the point being, if we're trying to validate this notion that market price can in fact be modeled by a simplistic set of structures, then what we would expect is a realistic appearance time series, price series, regardless of product. So, you know, we can jump to nat gas. We can look at bonds, we can look at, so I mean, you know, the point should be pretty clear. It doesn't matter, we can pick any product. You know, let's go back to crude. And we see that we get, within the construction of our series, things that are occurring in price. So, you know, these jumps here, for example, we get them in this series actually occurring, you know, almost at the same time. And so if we regenerate this plot, you know, each time it's going to be different, right? So, you know, now we see, well, once again, you know, the point here isn't, oh, did it predict the final price correctly? No, that's not the point at all. It's, does the image capture the way in which price moves? And so that part should be clear that, yes, in fact, it does. So, now the question becomes, what can we do with that information? Now, some of you might have guessed this at this point already, but what we're going to do is use this construct, try to identify these patterns, and then look for traits based on these. Now, I'm not going to dig into the actual analysis of assessing the probabilities of these, which is you know, obviously a crucial element. What to look for, when to stay away, etc., etc., because that's a whole another lengthy conversation. For those of you still here at this point, we're 30 minutes in, so I'm going to try to keep it reasonable. But, you know, effectively that's what we're going to do. So, for example, if we know in a long continuation, yeah, that's helpful, that, give me my stroke back, okay, that price rises, pulls back, and continues to rise, then we might look for entries at the pullback. This is a very common trade. Same thing on the short side. So, what might that look like? Okay, let's see if we can just find one on this chart. I'm trying to find a nice clean example. Okay, here we go. And, you know, the purpose of this is just to showcase the patterns. I'm not saying, you know, take this particular trade or anything. But here is a good illustration of a continuation. Price rises, pulls back, continues to rise. Pulls back, continues to rise. Pulls back, is a little flat, continues to rise. Right? And then, you know, ultimately we're going to have two steps in here as well, and shorts and other things. Now, of course, like, we can do this manually and come in and say, okay, you know, we're drawing out our areas and doing this, you know, bar by bar, or coming through and trying to find trigger lines for our pullbacks or retracements. And I know folks that do this by hand. That sounds absolutely terrible. right? So what if instead of that mess, we could have it all programmatically done for us, right? Which is exactly what we have here, right? So in this particular instance, we're running this code. It's only a few lines, really simple. We define our swing high, swing low, and then a lagged variable of it. We're using an EMA as a trigger line. You know, and this is wheat over the past 3 days, plotted on a range chart. We can get into the specifics of what that is, why use range charts as compared to time charts, etc., etc. Another time. What I just want to do really quickly is show, you know, kind of what you would be looking for. I hate having to draw in this natively, but you know, okay, let's do it. So here we see a, wow, that's invisible. Let's make you yellow. There we go. I see it. So we see price pushes up. We're in an uptrend, short term. Then we get a pullback to really every line. Shit. This is why I love Thinkorswim. Get a pullback to our trigger line. Just using the 13 EMA as the trigger line. Super common method. So, you know, this would be a potential buying area, and we're not going to get into where, you know, where and how do you place your stops, where do you place your targets. You know, all I'm doing is just illustrating the analysis of these patterns, how it flows out in the process of the chart. So this would be a buying area, we know, because if this pattern holds, then we're going to see this behavior. And the reason we can make that assumption, the reason we can even go in and make that assumption, is because we've proven that price is well explained by the amalgamation of these 4 basic patterns. So we know that these things are occurring. Just a matter of identification and playing them, and then using appropriate risk reward in combination with money management to execute good trades. So here we get long. Whoa, draw some more circles. Here we get long, and we see we get an excursion all the way up here. Never take any heat on it. Perfect trade. This doesn't happen every time. And I picked wheat at random. I didn't choose this before or anything. It's completely random. So we see that continuation, long continuation pattern right here, right? Exactly as we talked about before. So now, it's really cool, is this sets us up straight into a 2-step. So let's do 2-step in a different color. So what we see is we get a push down, all right, through the trigger line. Let's do this in purple. Then we expect, if the price is going to continue to increase, then we need to break this high. What happens? We come up here, form a lower high. So now we're on the lookout for a 2-step. And what do we get? sure enough, when we break this low, our two-step is confirmed, and we see that price goes down more or less relentlessly from there. So here we see our, right, this structure, which is this guy. Coincidence? I don't think so. And look at the opportunities that we're getting in between. So say we don't like two steps. We don't like playing that. We just want to play continuations. Well, okay. Ah, jeez. Here's a potential short entry. Here's another short entry. Right? And so it goes on and on. So that's the 20-second overview of how all these things are connected, how they work. And I think the important thing, obviously we didn't go into, okay, well, how do we actually set up a trade plan revolving around this? How do we calculate probabilities, etc., etc.? We'll do that in another session, another video. This is just meant to get you to think about price in a different way. Think about what's relevant. Notice I don't have tons of oscillators. I don't have a MACD and an RSI and stochastic and just shit everywhere all over my charts. What am I using? Using these 4 basic patterns, right? From there I can go in and design a trade plan assuming that my probabilities are in check. I have acceptable risk reward. The other things that we talked about in the path dependency analysis, that I put up earlier. From there we can build a plan. But what I wanted to illustrate with this is, merely a different way of thinking. And I think this is really powerful, both from the perspective of simplicity, as well as from functionality, right? And what I'll do as well is, for those of you, I think that's great, is, Thinkorswim is a free platform. So for those of you interested in this code, it's not long, a couple hundred lines, 146 lines. If you're interested in playing with this, seeing how affecting these parameters changes things, just exploring it, or whatever the case may be, I'm more than happy to share it, the code. I'll probably put up a Dropbox link similar to the Monte Carlo workbook that I did before. And I think between this discussion and our prior work on looking at risk reward and position sizing, we have what we need to actually dig into the formation of strategies and stuff next time. So with that, I want to wrap up. Hopefully you have found this, if nothing else, intriguing, interesting, made you think of things in a slightly different way. Let me know your thoughts. Leave any questions, comments, concerns, and look forward to bridging all of these concepts together in the formation of an actual executable plan. Hopefully next time put something together. So thanks so much, and until then.